Hello, it's John Burford, and this is another short video of an example of how I use my tramline trading methods in a real live situation. This is a live chart of natural gas, which has been extremely volatile recently, as you can see. But when I started analyzing it, I started actually from way back here, a couple of years ago, really. And I recognized the market was in these highly overlapping waves that were going nowhere. If you were starting to trade this, you'd probably get whipsawed to death. So I basically stayed out. But I was watching it because I knew something was about to happen. And what happened was I connected these lows here. That one there, that's number 3, that's number 4. And that's my lower line of support. And then I connected this high here with that high there. That's number 2, number 3, and number 4, and produce that line. And that formation is a wedge or a contracting triangle, some people call it. But it is a very powerful pattern, and I look out for these on any chart that I'm looking at. The basic feature of a wedge is that it's a bit like a coiled spring. You see the waves are getting narrower and narrower as we get towards the end. Those are very narrow, shallow waves. It's like a coiled spring there, so that once it pops out, it's going to go haywire. And that's exactly what happened here. This was your buy signal as it moved above this line of resistance and moved swiftly up. Now, I must tell you about a hedge fund recently that blew itself up simply because it was the wrong way positioned. In other words, it was positioned short natural gas and long crude oil. Now, if you know anything about what's happened to crude oil lately, that is entirely the opposite way to make money. In fact, they lost so much they had to close it down, and the investors lost a ton of money. But luckily, I was able to get on the right side of it. We got long around here. I didn't expect this, though, by the way, but I was glad of it when it happened. But if we go back to this point here, this is where I believe the formation started. I was looking at that as wave 1, that's wave 2, and this is wave 3, obviously, because wave 3 is long and strong. They're always long and strong, so that's the giveaway there. Now I'm looking for wave 4, which is usually in a 1, 2, 3 or an ABC pattern. There's your A, there's your B, there's your C. That complies. So what's happened? The market has crashed all the way down to the Fibonacci 62% level. And that's normally the level at which turns occur. So I'm looking at this as quite likely a wave 4 low. And I'm looking for a rally back up here. And if I'm right, this is wave 5, and it'll take the market way up here into new high ground. So the potential for profit is very large. So what are my risks? Well, I think a stop placed down here would be sensible. And if the market does not close this gap, that's a very bullish sign, and the market will likely rocket away up here as more short positioned hedge funds are forced to close their positions. So this is a very interesting setup here. Now the thing about a wedge, I told you they're very interesting and very lucrative patterns. That one of the rules about them is that once they break out, like it did here, the minimum expectation is to move back up to that high point there, which is right here. And of course it made it very quickly, but then of course moved much further on. So that is a very unusual thing to see a very sharp rise like this, not so much in commodities like natural gas, but certainly in the stock market. It's quite rare to see this sort of massive short covering surge. Okay, that's one market, and in the next video I will investigate another market which I hope will be just as interesting.